SolarEdge Technologies, ticker symbol SEDG, is currently trading at $39.53, marking a significant intraday jump of $3.87, which is a powerful 10.85% gain for the day. While a double-digit percentage gain might have investors who use platforms from Fidelity to Robinhood thinking the bottom is finally in for this beleaguered solar stock, the reality is far more complex and treacherous. This sudden burst of optimism isn't necessarily a signal of a fundamental turnaround. Rather, it has all the hallmarks of a classic, violent short squeeze, fueled by sector-specific news and a market desperate for any sign of life in the green energy space. Understanding the difference between a technical bounce and a true business recovery is absolutely critical for anyone considering a position in this name, whether through a SoFi Invest account or a more sophisticated setup with interactive brokers. For years, the expectation surrounding companies like SolarEdge has been straightforward and compelling. As the world inevitably transitions to green energy, manufacturers of solar inverters and power optimizers are positioned as guaranteed long-term winners. It's a clean, appealing story of secular growth, environmental responsibility, and government support that has attracted a substantial amount of capital from both retail and institutional investors. Many have built positions through various investing sites, hoping to ride this multi-decade wave. The common belief was that demand was almost inelastic and that growth was a given. But the reality of the last 18 months has been a brutal lesson in market dynamics, where macroeconomic forces can decimate even the most appealing narratives. The story of inevitable growth crashed head-on into the unforgiving wall of soaring interest rates, a debilitating inventory glut across European distribution channels, and a structural shift in residential solar demand in key markets like California, following the NEM 3.0 policy change. Today's 10.85% surge doesn't erase that extensive damage. It's a volatile, reflexive reaction within a deeply distressed and long-term downtrend. Let's dissect today's specific movement. A move of this magnitude is rarely based on nothing. It is often a reaction to a broader sector catalyst. For instance, positive commentary from a competitor like Enphase, a surprisingly strong earnings report from a panel manufacturer, or even a slight dip in treasury yields can act as the spark. In a stock as heavily shorted as SolarEdge, where a significant percentage of the float is held by investors betting on a further price decline, this spark can ignite a firestorm of short covering. As the stock begins to rise, short sellers are forced to buy back shares to close their positions and limit their losses, which in turn pushes the stock price even higher, creating a feedback loop. The trading volume today is substantially higher than its daily average, which confirms this is not a quiet drift upwards. This is an explosive, high-participation event. Many retail traders on the Robinhood app are likely piling in, chasing the momentum, while institutional desks using the advanced interactive brokers trading platform are executing complex strategies to either cover shorts or take new positions based on the volatility. This is a battleground, and the price action reflects that conflict. Looking beyond the daily noise, the macroeconomic pressures remain the primary driver of SolarEdge's fate. The business model of residential and commercial solar is acutely sensitive to interest rates. Installers and homeowners often finance these significant capital expenditures, and when the cost of borrowing goes up, the economic appeal of solar installation goes down. The Federal Reserve's aggressive rate hiking cycle to combat inflation has been a direct headwind for the entire industry. While giants like Apple stock or Nvidia stock have their own macro sensitivities, the solar industry's direct link to financing costs makes it particularly vulnerable. Any hint of a pause or a future pivot by the Fed sends ripples of hope through these names, but the underlying reality is that rates are still at levels that constrain demand significantly. Furthermore, the situation in Europe, a critical market for SolarEdge, has been disastrous. During the energy crisis of 2022, distributors overordered products on a massive scale, anticipating continued frantic demand. That demand evaporated as energy prices stabilized and economic conditions weakened, leaving a mountain of unsold inverters and optimizers sitting in warehouses. SolarEdge has been forced to dramatically slash shipments to these channels to allow them time to work through this excess inventory, which has crushed their revenue and profitability. This isn't a problem that gets solved in a single quarter. It's a painful, slow process of rebalancing that will likely continue to suppress financial results for the foreseeable future. A one-day pop, no matter how impressive, doesn't clear out a warehouse of inverters. For those who may be new to the company, let's establish what SolarEdge actually does. It doesn't manufacture the solar panels themselves. Instead, it creates the critical brains of the solar energy system. Its core product is a DC-optimized inverter system. In a typical solar setup, multiple panels are linked together in a string. If one panel is shaded or underperforming, it can degrade the output of the entire string. SolarEdge's technology attaches a small electronic device called a power optimizer to each individual panel. This allows every panel to operate at its maximum potential, independent of the others, and then sends that optimized power to a central inverter to be converted from DC to AC for use in the home or business. This architecture competes directly with microinverters, the specialty of its main rival, Enphase, which places small inverter on every single panel. The company's business model relies on selling this hardware, along with monitoring software and increasingly energy storage solutions like batteries. The company has a strong technological foundation and a significant global footprint, but its financial performance is directly tied to the rate of new solar installations, a metric that has been under severe pressure. When looking at platforms offering investment help, such as the educational resources on Fidelity or SoFi Invest, understanding this business model is the first step in any proper analysis of the investment. The recent earnings reports have painted a bleak picture, confirming the severity of the challenges. Management has been transparent about the weak demand and the severe impact of the inventory destocking process. They have provided guidance that fell far short of Wall Street's expectations, which is what precipitated the stock's massive decline over the past year. Analysts have been in a race to downgrade the stock and slash their price targets. Institutional ownership, while still present, has seen significant shifts as growth-oriented funds have exited, replaced by value or distressed asset investors who are trying to pick a bottom. Tracking these institutional moves is a key part of online investing, and tools on platforms like the Fidelity mobile app or through an individual brokerage account can provide some insight into these trends. However, the core takeaway is that the company is in a defensive crouch, managing a downturn rather than executing on a growth plan. That is the reality that contrasts so stripe with the long-term optimistic expectation. Many investors have seen the value of their holdings plummet, questioning if this is a temporary downturn or a permanent impairment to the business thesis, similar to the agonizing reappraisals that have happened with other former high flyers. This brings up a crucial question for anyone invested in the green energy space. Comment below with your thoughts. Do you believe the inventory glut in the European solar channel will be cleared by mid-2026? Or is this a longer-term problem that will suppress margins for years to come? Looking forward, the future outlook for SolarEdge presents a stark dichotomy. The bull case, which represents the hopeful expectation, hinges on a macroeconomic reversal. If inflation subsides and the Federal Reserve begins to cut interest rates, financing for solar projects will become cheaper, stimulating demand. As the excess inventory in Europe is finally worked through, orders will begin to normalize and revenue growth will return. Bulls point to the long-term undeniable need for renewable energy and government initiatives like the Inflation Reduction Act as powerful, enduring tailwinds. They believe that the company's technology is solid and that once the cyclical downturn ends, SolarEdge will emerge leaner and ready to capture the next wave of growth. This is the scenario many who invest online are betting on, perhaps using automated tools like Schwab Intelligent Portfolios to maintain exposure to the sector. The bear case, however, is grounded in the current harsh reality. The primary risk is that interest rates remain higher for longer than expected, continuing to stifle demand for solar installations. The inventory problem in Europe could prove more stubborn than anticipated, and renewed competition from lower-cost Chinese manufacturers could put permanent pressure on SolarEdge's gross margins. Bears would argue that today's jump is a dead cat bounce, a temporary recovery in a stock destined for further lows as the fundamental business deterioration continues to play out. They would caution that making a significant investment based on a single day of positive price action is a